In 2024, a retired teacher in Ohio sold her late husband's small business. She thought she was being smart. She paid the capital gains. She reported everything correctly. She slept fine. Then January 2026 arrived, and a letter from Social Security told her something that made her hands shake. Her Medicare premium had just doubled. Not because of anything she did this year, because of something she did 2 years ago. And the IRS doesn't send warning letters for this one. They just take the money. If you're 65 or older, the IRS changed 4 major rules for 2026. Most seniors filing their taxes right now have no idea these rules exist. And the cost of not knowing, it can run into the tens of thousands of dollars. This isn't about loopholes. This isn't about cheating the system. This is about understanding rules that were rewritten while most Americans were watching something else. Let's start with the one that sounds like good news, because it's the most dangerous kind of good news. Rule number 1, the $6,000 senior bonus deduction. In July of 2025, Congress passed something called the One Big Beautiful Bill. Buried inside it was a provision that, on paper, looks like a gift. If you're 65 or older, you can now deduct an additional $6,000 from your taxable income. Married couples can deduct $12,000. And here's the part that changes everything. You can take this deduction even if you itemize. Before this, seniors who itemized their deductions, people with mortgage interest, medical expenses, charitable giving, got nothing extra just for being older. Now they do. The average Social Security benefit is about $24,000 a year. Up to 85% of that, about $20,400, can be taxable. This new deduction, it covers that. For millions of seniors, it means Social Security benefits become effectively tax-free at the federal level. But here's where it gets complicated, and this is why most people miss it. This deduction phases out. If your modified adjusted gross income is over $75,000 as a single filer or $150,000 married, the deduction starts shrinking. By $175,000 single or $250,000 married, it's gone entirely. And the phase-out isn't gradual. It's $60 lost for every $1,000 you earn over the limit. So a senior with $85,000 in income doesn't get $6,000. They get $5,400. A senior with $100,000 gets $4,500. And if you're not paying attention to where your income lands, you can accidentally cross a threshold and lose thousands in deductions without realizing it. This rule applies to your 2025 tax return, the one you're filing right now. And the IRS doesn't send you a reminder. You have to know to claim it. But that's just the beginning, because rule number 2 is where families lose inheritances. In 2019, Congress passed the Secure Act. It changed how inherited retirement accounts work. Before that, if you inherited your parents' IRA, you could stretch withdrawals over your lifetime. A 45-year-old could spread distributions across nearly 40 years. That was called the Stretch IRA. The Secure Act killed it. Now, for most non-spouse beneficiaries, the entire inherited IRA must be emptied within 10 years of the original owner's death. But here's what most people still don't understand, and the IRS made this crystal clear in final regulations that took full effect in 2025 and 2026. If the person who died had already started taking required minimum distributions, meaning they were 73 or older, you can't just wait until year 10 and cash out. You must take annual distributions in years 1 through 9, calculated using your own life expectancy, and empty the account by year 10. Miss one of those annual distributions, the penalty is 25% of what you should have withdrawn. That's not a typo. 25%. The IRS will take a quarter of your inheritance because you didn't know the calendar. And here's the part that destroys wealth. Most beneficiaries do the default thing. They take the minimum each year, then empty the account in year 10. On a $500,000 inherited traditional IRA, that pushes roughly $420,000 into a single tax year. Your tax bracket jumps from 22% to 35% in 1 year. The federal tax bill on that single distribution, approximately $109,000. The difference between the best withdrawal strategy and the worst one, over $25,000 in total federal taxes on the same inheritance from the same account. The IRS doesn't care which strategy you chose, they just cash the check. If you inherited an IRA in the last few years, or you expect to, this rule is not optional knowledge, it's survival. Now, rule number 3, and this one targets people who think they're doing everything right. Starting January 1st, 2026, if you're 50 or older and you earned more than $150,000 in the previous year, your catch-up contributions to a 401k must go into a Roth account. Not pre-tax, Roth, after tax, no deduction, no immediate tax break. Before this, high earners could choose. They could put that extra $8,000 into pre-tax, lower their taxable income, and defer the tax until retirement. That option is gone. If your employer's 401k plan doesn't offer a Roth option, you lose the catch-up contribution entirely. Not the base contribution, that still works, but the extra $8,000, gone. The super catch-up for ages 60 to 63, that's $11,250 you can no longer put away if your plan doesn't support Roth. The IRS calls this encouraging retirement savings. What it actually does is force high earners into a Roth bucket, whether they want it or not. For someone in the 32% or 35% tax bracket, losing that pre-tax deduction means writing a bigger check to the IRS this year. The trade-off is tax-free withdrawals later, but not everyone wants that trade-off. And starting in 2026, you don't get a choice. If you're 59, you've been maxing out your 401k for decades, and you're planning one last push before retirement, you need to check your plan documents today. Because if your employer hasn't added a Roth option, your catch-up contributions just disappeared. And most people won't find out until they review their first paycheck of 2026. Now, the 4th rule. And this is the one that feels like a trap, because it is. Rule number 4, IRMAA, the stealth tax that looks backward. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on your Medicare Part B and Part D premiums if your income is above certain thresholds. For 2026, the first surcharge kicks in when your modified adjusted gross income exceeds $109,000 for individuals, or $218,000 for married couples. But here's the part that makes people furious. Medicare doesn't use your 2025 income to determine your 2026 premiums. It uses your 2024 income, 2 years ago, the income you already reported, already paid taxes on, and probably already spent. So if you sold a house in 2024, if you did a Roth conversion, if you took a large IRA withdrawal, if you were still working and earning a high salary, if you sold stock for a gain, all of that income from 2 years ago is now determining how much extra you pay for Medicare in 2026. And the surcharges are not small. At the highest tier, you can pay hundreds of dollars extra per person per month. For a married couple, that's thousands of dollars per year. And the hold harmless provision that protects most Social Security recipients from premium increases, it does not apply to IRMAA. Your Social Security check can shrink, and it will. The worst part? You can't go back and change 2024. It's done. But you can file Form SSA 44 to appeal if you've had a qualifying life-changing event. Retirement, death of a spouse, loss of income, divorce. These are the events that can reset your IRMAA determination. But you have to know to file, and you have to know when. Most seniors who get that IRMAA letter in January 2026 will just pay it. They'll assume it's correct. They won't know they can fight it. They won't know that a 2-year-old tax return is being used against them. And they won't know that one form filed correctly could save them thousands. So let's put this together, because these 4 rules don't exist in isolation. They interact, and that's where the real danger lives. The $6,000 senior deduction can lower your taxable income, but if you're doing Roth conversions to build tax-free wealth, those conversions increase your MAGI. That MAGI can push you into an IRMAA surcharge 2 years later. Meanwhile, your inherited IRA distributions count as ordinary income. If you're not strategic about when you take them, they can cost you the senior deduction, trigger IRMAA, and land you in a higher tax bracket all at once. A retiree in 2026 is not just filing a tax return. They're navigating a system where one decision creates ripples across 3 different rules, and the IRS is not in the business of warning you about the ripples. Here's what you need to do. First, if you're 65 or older and filing your 2025 tax return, check whether you qualify for the $6,000 senior bonus deduction. Look at your modified adjusted gross income. If it's under $75,000 single or $150,000 married, claim the full amount. If it's over, calculate the phase out. Don't leave money on the table because you didn't know the rule existed. Second, if you inherited an IRA in the last few years, or you have elderly parents with retirement accounts, understand the 10-year rule. Know whether the original owner had started RMDs. If they had, you need annual distributions. Set a calendar reminder. Talk to a tax professional. The 25% penalty is not a negotiation. It's automatic. Third, if you're 50 or older and earn over $150,000, check your 401k plan for a Roth option. If it doesn't have one, talk to your employer about adding it, because without it, your catch-up contributions are gone. And if your plan does have Roth, understand that your tax bill this year will be higher. Plan for it. Fourth, if you're on Medicare and your income was high in 2024, watch for the IRMAA letter. Don't just pay it. Evaluate whether you qualify for an appeal. File Form SSA 44 if you've had a qualifying life event. The difference between accepting IRMAA and fighting it can be thousands of dollars per year. The IRS didn't announce these changes with a press conference. They didn't send letters to every senior in America. They published them in regulations, updated forms, and inflation adjustments, and they expect you to know. Most people won't, but you're not most people. You watched this video, and now you know what your neighbors, your coworkers, and maybe even your accountant missed. Tax rules are not suggestions. They're the architecture of how money moves in this country. And in 2026, that architecture changed for seniors in 4 specific ways. The question is not whether these rules affect you. The question is whether you'll let them cost you money, or whether you'll use them to keep what you've earned. If this helped you understand something that could save you thousands, share it with someone who needs to see it. Subscribe to SH Finance for more breakdowns that actually matter. And before you file your 2025 tax return, talk to a qualified tax professional, because the rules have changed, and knowing the new rules is the only way to win.